Obviously, the current situation brings back memories of 2008, the global financial crisis, the last time where we experienced a very large deflationary shock to the economy, even though from quite a different source. And therefore, I think it's important to remember the lessons learned at that time, because back then a lot of investors thought that inflation would raise its head very quickly, given the very strong monetary policy response, large fiscal programs that were enacted, but none of that came to pass. On the contrary, it took extremely long for inflation to gradually return as output gaps finally closed again. In fact, in Europe, even now, we are still below the target inflation levels that central banks have been trying to achieve without much success for the past 10 years. Therefore, we believe that interest rates are going to remain well contained for the next 1 to 2 years. At the short end, due to monetary repression by the central banks. At the long end, for one, due to the recessionary growth outlook that should keep real rates anchored at low levels. And furthermore, the reenactment of large-scale asset purchase programs by central banks with the intent to control the yield curve further out should also keep things under control. Over the medium and long term, we indeed believe that inflation is going to become a problem. For one, the programs on the liquidity side in terms of central bank support, as well as on the fiscal side, as they have been proposed by now, already exceed anything that was enacted during the global financial crisis. At the same time, we see governments much more constrained in terms of their ability to take on further debt. This has given rise to a number of fringe theories that have gained acceptance, such as modern monetary theory, even though until recently they have been opposed, not only for ideological reasons, by a large part of the economic community. Now, monetizing these further debts is something that has become quickly quite acceptable. In fact, it looks as if the US fiscal rescue program will be largely monetized. And while this is not going to be a problem over the short term, while output gaps are wide, once they close, the incentives will make it very difficult for politicians to stop issuing even further debt that doesn't seem to have to be paid for. And therefore, we believe that it's quite likely that we are going to end up in a possibly stagflation, which of course will also spill over into bond yields, where we would expect a significant backup of bond yields despite low growth if this scenario came to pass. Clearly, for investors, given the timing of our outlook, it's probably a bit premature to go all in terms of positioning for higher inflation at this time. But some preparation might be worthwhile, considering that pricing of inflation risk is very low right now. Looking, for example, at break-even inflation as is contained in inflation-linked bonds, or looking to the inflation swaps market. So it might make sense to take a look at hybrid structures that at this time can take advantage of the fact that issuers have been coming under funding pressure, which means they've had to raise the funding rates that they offer in structures. So even in Swiss francs or euros, it's become quite attractive to invest in a floating rate note or a fixed rate note. Combining that with an exposure to inflation swaps can create a structure that, if of considerably of long maturity, at least 4 to 5 years, could be an interesting investment at this point. We would also point to gold as an interesting asset at this stage, not as much because it is an inflation hedge. We don't really subscribe to that theory, but it has come under pressure in recent weeks as well, with the large-scale liquidation that we saw across all asset classes. And as such, there's a good entry point, and gold has been proven as a quite effective hedge in systemic crisis as we are facing it right now.